Well, hello everybody. August 30th, end of the month, weekly review, where we take a look at what happened last week, and boy, did it happen, and what we think is probably going to follow. So the first thing I guess we should note is, despite that huge plunge on Monday, we end the week higher. So in other words, we got a huge bounce off that. And I saw, comparisons about, the largest bounce we've seen since 2009, the largest plunge we've seen since, I think it was, I don't remember when it was. It was a big plunge, and anyway, the stats are out there, and the point is that, the biggest bounces come within the biggest declines. I mean, that's just the way it happens. And so to see a huge bounce off of a big decline, a fast compressed decline, is normal. It's actually expected. So that doesn't really tell you anything other than, when you see these huge declines, you don't want to panic into them. You want to, hopefully be positioned as we were to absorb it and maybe to profit by it, and then to actually turn around and take advantage of it. And that really is the key to outperforming over time. Now, the other thing that actually happened on Monday, which caught myself and many, I'm sure, by surprise, was we got that flash crash. Basically, we had stocks and ETFs go down huge percentages, abnormally huge percentages, and those declines, they were absurd in many cases. Here's just one. This was one of the stronger sectors out there, the home construction. It's one we tried to trade long, and we ended up giving up on it, and then it made a new high, and now it made this big drop. But look at the decline on Monday. Absurd. And we saw this in many, many stocks and ETFs. If you had stops in, you got stopped out. If you look back at what I did Monday before the open, I took all the stops out, took them out, and that was because we did not have a lot of inventory. In other words, we could absorb anything that took place and then decide what to do about it. And that, doesn't happen often. It happened back in 2010, in May of 2010. It happened again Monday. And it's not some, devious, they're taking you to the cleaners kind of thing. It's a function of somewhat of an illiquid market, pressures external, creating a lot of fear, opening up on a Monday and plunging, and the liquidity just not being there. You had the Rule 48. I actually wrote about all this on the front page if you want to go read about it in the columns that I write. And it created some opportunity if you were sitting there at your terminals and you could buy. And those who were in the TNT room with me saw me, say right off the bat Monday I was buying when everything was plunging, because the levels they were plunging to were absurd, and it was an opportunity to take advantage of it. If you were more flexible, or you have a more flexible schedule to where you can do that intraday. But most of you, like I used to be, don't have that flexibility, right? You're working a real job, and you have to take advantage of what you can, and that is that you're not going to make those kinds of gains usually. What you're going to try to do is void those kinds of losses. And so, this big bungee jump that took place, you could have taken advantage of it the next day, and we did that with the IWM, even though it turned out not to be the best instrument. But this bungee jump, where you have this compressed move down, fast, compressed, large percentages, right, leads to large percentage moves back the other way. And so if you can see a setup down here that makes sense, which it did, after this big move down, and you can take advantage of it. In other words, you don't have too much inventory on hand, and your mind is positive, not negative, then you can do some buying here with the assumption that you will get this kind of move on the way back up. And that's what I tried to do in the portfolio and tried to show you, and hopefully that message came across. Now that we're back up, right, the risk is that what we're going to see next is some sort of a rollover right, where this thing kind of rolls back over and attempts to set up some sort of an ABCD structure to get it higher. So in other words, come back and then try to go higher and get back into this retest regenerate zone. And I'm going to talk about that more later on one of the member questions, so I'll leave that in detail until then. In most cases though, right, and I'm going to go to the stronger ones now, we're going to do it in more than 6 bars. Now, this is the strongest index, the NDX. And the NDX, it's actually on the 5th bar now. So here's the break. And so you have 5 bars here on this bounce. You're not quite back to the bottom of that bar that was broken, right? That's the retest regenerate bar. If it gets into it tomorrow, then that would be less than 6 bars, right? It would be on the 6th bar. So if you go, let's just say we don't open higher on Monday and we actually open lower and we don't get a new high and we don't get into this bar, then it's going to be 6 bars. Now, the reason that's important is when you have 6 bars and you had a breakdown, right, of this magnitude, you had a breakdown, multiple swing points broken. If you don't get back up there in 6 bars, you've got about a 93%, anywhere from 92 to 95%, depending on the time frame and the trend qualified, whether it's suspect or bearish. Suspect or confirmed. You got anywhere from 92 to 95% chance of this thing actually regenerating lower. That's a big deal. That's a huge percentage to work against. So what it tells us, and even if we get back up here within 6 bars, right, the probabilities are still fairly high. So the point is that when you get these kinds of breaks, the idea that this thing is going to V-shape straight back up is not a high probability bet, right? To get back over this area, to get back in this case on the NDX over 44.35, the probability is extremely low. And so recognizing that, we have to assume that what we're going to see here is we're not going to see, something going straight back up, but instead we're going to see this thing roll back over and try to set up potentially that ABCD structure. Now, if we take that same idea, right, and we look back at some of the weaker indexes, like in this case the S&P 500, right, the probability of getting back up here is almost nil within 6 bars. And so the ideal here that this is going to take time to do whatever it's going to do is probably true, and do whatever it's due is probably going to be, the same sort of thing, some sort of a rollover, an attempt to set up a push back higher. So that's the way the indexes are set up, and that's what we should be thinking with respect to them in the coming weeks ahead. Now, on a more positive note, if we look at the weekly chart, and this is what makes me think that we're not going to just sell off from here, but instead we're going to actually find support as we retrace, when we retrace, is that here on the S&P 500, on the weekly, right, you had these swing point lows broken, as well as these up here. So you had 4 broken on the way down. That compressed move, fast move, right, came into the October lows. Now this is a negative, had more volume, so you test in there and you have more volume, but you hammer reverse and you head higher. Even though you have more volume, you head back higher and you get back into these swing point lows. That says that, hey, this thing did not, the sellers were unwilling to sell more and continue to sell more at lower prices. If they're not willing to sell more at lower prices, then what are they going to do? They're probably going to turn around and they're going to buy, and that's what they're doing, and that's probably what's going to extend this thing farther out before we do get a further decline, if in fact that is what we're going to get. Another event over the weekend here now was Jackson Hole, and the Fed came out and they seem to be telling us that they're not going to raise rates if market volatility is high. And so the futures has already bumped up over the weekend, right, to assume that we're going to get a rate increase, because remember, we were coming in buying the news thinking the Fed would not raise, and they're still holding out the possibility of raising in September if market volatility isn't that high. The conditions they put on this first rate raise are amazing. I mean, we've heard, the whole, for 3 years now, we've heard this, we're going to raise rates. And every time we get close, well, there's another condition we got to meet. Well, now we have a market volatility condition. It's a tortured move to try and raise rates, and you can understand why, because the world is living off QE, and to suddenly actually raise rates again and try to move back to something that used to be normal, where Fed actually raised rates and lowered rates to actually move policy, that seems like, abnormal anymore. Now, another big event last week was China. And China, I believe, is a huge problem. You had an ABCD structure fire. It wasn't a large one, and it's really, it's kind of a tortured one here. It fired right and got the move down and fulfilled and all that, but it broke a swing point low on the way down. Now it's potentially setting up another ABCD structure, right, to take it lower. Given this size of this swing point low, right, it could actually bounce all the way back up to here before it came back down, so we wouldn't get quite as big of a move. But the point is that now China is set up on this break to actually trade lower. And if you look at it on a weekly time frame, you can see the break of this swing point low. Also, ABCD structure here as a result of that. So if we take it off the high, get the bounce, right, and then extend it, you can see the kind of damage that could be done. What I'm not seeing is the volatility in terms of volume that we saw before. If you go back here, look at these volumes, look at how you're coming into them, you don't have the volume to break it down now. So what does that say? That says more than likely, just like we're talking about here in the US, this move down, assuming it's going to come, is going to take time, right? It's going to play out over time. It's not going to be immediate. So that's another consideration to have with respect to how these markets are going to trade. And China is a big mover of what's happening in these markets, and we'll talk about that a little bit later as well. So technically, what we've already looked at here is that the markets finished off the projections to the downside, and it was even more than was called for, with respect to those projections. And what I mean by that is, no matter how you measure this thing, if you just do the range that we were looking for, right, that range, not only did it, go down farther than when we expected, right, it plunged on down. We went down 3 levels versus just, the one. So range-wise, big move down, right? The projections were overshot. If you take it here on the weekly and do the full range all the way back to here, even that projection was overshot, right? So we've had projections to the downside now that have overshot, and in doing so, right, they've created an extreme situation of which we've got an extreme bounce off of that. If we look at the weekly, monthly volumes, right, they weren't as heavy this time around as they were in the 2014 in most cases. So if I take like the NASDAQ, for example, and look at it, look at the volumes here compared to the volumes here on the October, on a weekly basis, slightly higher, but not that much. But if you pull over the monthly, it's not even close. The volumes here swamped the volumes there. And you pressed into it with pretty good volume, but it certainly wasn't enough to keep it down there. And so, that's a positive. That's something that you have to look at and say, okay, that's not a bad deal. Another positive, and I know I'm stretching here to find positives, but if I look at the CACs, for example, the CACs barely got over that bearish retest regen. That's also a positive when you think about it. That's not a bad thing. The question is will others follow, or is this, kind of the one and done kind of shot? And that's the same thing here on the ITB. If we're looking internal to our markets, looking at one of the stronger sectors, right? This breaks, gets back over this one, also gets back over that one. So you can see how this strong sector is already back up and above. And so, there's some small positives already starting to take place. They're nothing to, get too excited about. But again, you're looking to see how the strongest react and how they behave on their bounces. Now, across the globe, it wasn't the same, right? We actually saw volume increase as we came back into the lows of last year, pretty much across the board in most markets around the world. Even in France, for example, volume's increasing here as we're coming back in. Doing 8.6 there, you come into it with 9.5. Hong Kong, for example, volume expanding, right, as you come back into these areas. And speaking of Hong Kong, not only do you have volume expanding, you actually have breaks on the monthly chart now. Breaks that look to be effective unless they have a huge rally tonight, which I don't expect. In other words, they're going to trend transition to a lower trend. We haven't seen that in almost half a decade. And in almost all these cases, all these bearish trend transitions that have taken place now, all of them are young. In other words, they've just gotten underway, right? That is a big no-no, because it says that this move now on the bearish side can actually extend for some period of time. Now, fundamentally, it's not all bad, especially in the U.S. The data seems to continue to say, the economy's doing reasonably well. I mean, given all the world's problems, U.S. problems, not there. Matter of fact, all the pressure we're seeing really is coming from over there versus here, and that is that, we, U.S., still doing pretty well economically. The Fed has floated two ideals this weekend. They both seem to be somewhat positive. We'll have to see how the market interprets them. One of them is that they're not going to raise rates on the volatility, which I mentioned earlier. And that should probably be an effective kind of a cap, if you will, on these markets melting. So in other words, anytime they start melting, everybody's going to start talking about, okay, the Fed's not going to raise rates. Same sort of thing, just different form. We've seen over and over and over. And then the other thing is they started floating is this idea that it's a one and done until inflation picks up now. So in other words, we're gonna raise rates and then we're gonna sit around and wait. And if inflation doesn't really start to pick up, then we will raise again. So that has to be viewed as kind of a positive, right? If you go on the negative side, though, there's evidence, greater evidence now that both China and Canada are probably in recessions already. And if you look at the percentages that these markets represent in terms of U.S. exports, it's almost a quarter of our percentage. Actually, it's a little bit more of our exports. And so if they're moving into recessions, they're not going to be buying as much goods. Therefore, manufacturers are going to have a harder time selling because 1/4 of what they sell to is not going to buy as much. Another big negative is that China is probably going to have to allow that renminbi to devalue further. And there's a pretty good, I've got a pointer here if you want to go listen to a video out of David Wu out of Bank of America on Bloomberg. One of the members sent this to me. I'd actually already seen it and he had done a couple of them already. And the ideal here is that you can't have your cake and eat it too. There's a situation where, given the market forces, if you're going to try to hold your currency steady when it's moving against you, which is what's happening now, in other words, the dollar's pressured higher, the renminbi should be pressured lower, especially if they're having a recession. Yet they don't want to let it fall too far too fast, so in order to keep that from happening, they have to go into the currency markets and buy it, which means they have to raise dollars to do it, which means they have to sell bonds. And so this whole situation where we're seeing bond pressure lower despite a sell-off in the markets, right? I mean, we had the sell-off in the market, and then these things really started to drop when that volatility was still high, especially on Tuesday. Now, maybe they were signaling they could see the turn, and they probably were to some extent, but for the kind of sell-off that we saw, we didn't see much of a rise here in bonds. And that's probably because of all the pressure of somebody selling them, and it would make sense maybe that China is doing that selling. That's what David Wu argues. I think he's onto something. Taking that whole thought, though, of China, farther. They're probably going to have to devalue. They're going to have to let that currency come down in order to affect what they're trying to do with respect to easing monetary policy and having it take effect inside the country. If that's true, that could put more pressure on everybody again, because I do believe there was a correlation between the Chinese devaluation and what happened in our markets, not just our markets, but the markets around the world, which led to our markets. Because if you remember, markets around the world were already collapsing before we did, and that was off that currency devaluation most likely. So in summary here, last week we were looking for these two things. We were looking for positive divergences and two-bar reversal setups to allow us to move higher. We did get that. We saw the two-bar reversal on the Russell, which had been the leader on the way down. You get under it, back over it, that leads to the big spike back up. And then we also saw the divergence, right, where the S&P was down here and couldn't lift, right, while at the same time the NASDAQ was lifting. And that divergence, of course, was a big part of what was taking place with respect to the big bounce and the violent move back the other way. So what do we expect this week? Well, actually the opposite. Right now we expect this big violent move to find that retest regens and start to push prices lower. So on the strongest ones, you're coming up to do the test. Expect those to push prices lower. And for Tuesday, Wednesday now to act as support on any retrace. So if I pull up any of these charts, you're going to see this area right in here, right? That's the Tuesday, Wednesday highs. That to be the support area on the first move back down. Now, in the case of the stronger ones, it may get a little deeper, but if you look at, like, say, the S&P 500, there you can see that, a little area there is probably where you have to expect that you're going to find the buyers. This is the logical place for them to try to come back in if they're going to. And given the way this market has been, such a bull market, they may even try to front run it and get ahead of it, right? But you have to expect, some sort of a move back down. If it happens, right, that would be the B point, C point, ABCD up to get you back up into this area, which is where the big retest regen is going to take place. This week there's an abundance of economic data, right? It's turn of the month, so you get all the PMIs, you got the beige book, you got the employment report, and you got a couple more Fed speakers. So it's going to be a busy week on the economic front, and I think that would continue to feed volatility. Finally, what's the bottom line? Although it's become commonplace now to expect these V-shaped reversals to take us back to new highs, right? Where you do a plunge like we did last October, and then you immediately come straight back up and do a new high. I don't believe that's going to be the case here. Now, I know it's starting to look that way already. Believe me, I'm quite aware of it. But if we're going to come all the way back up here without so much as a retrace, right, that is a high probability, extremely low probability of that occurring. It's just not likely. Possible? Sure, anything's possible in these markets. Is it likely? No, it's not. It's not even close. The reasons we keep seeing this kind of action is there's really no other place to put your money, right? I mean, there's not good alternatives to the market. The low rates of returns on almost anything you do as an alternative investment make it almost a slam dunk to put your money in the market versus somewhere else, and that's why nobody wants to leave this market. Now, the big risk, if we look at the risk, the huge risk here is that you're going to have a situation now where if we make the retest regen, so in other words, we do set up on a smaller basis, right, this move down, we get some sort of an ABCD structure inside of it, takes us back up to here, and then this fails and eventually we make new lows, right? We take out this area, we would break on both a weekly and a monthly if we broke down here. Assuming this sort of a pattern takes place, this was distribution at the top. And this bounce is where you're going to have to come out of this market if you're too long. And so, from a longer term perspective, and this is one of the members' questions this week, was to review this scenario again. This is the scenario you have to be most worried about, because if it sets up this way, or I mean, another case is that this sets up, fails here, and comes straight back down too, right? I mean, it could do that. In other words, you may not even get back up there. Either case, a move down that takes out this low and breaks these says this was a major top. That is a huge problem if you're way too long in these markets. And so that's where the real risk is. And as I said last week, don't expect this market to go make new highs anytime soon. Even if it's going to go higher, it's going to take a while. It's just not going to happen right away. Those scenarios I just talked about play out. It's going to take us back up. If we get that bounce off a small retrace, it's going to take us back into the Fed rate decision in terms of timing, right? And it's going to make most investors and traders feel like, hey, it's the same thing, right? You got to be invested because this market always goes higher. So just to review that member question in the context of what we just talked about, last week I was saying that this market had some congestion in this area. It was about 20, well, it was about 2,000, right? It was right about here, and we're almost there. That looked to be as far as this thing could go. I thought that it might break here, but I gave it the benefit of the doubt and said, hey, given the way these bulls always come back, you could make it up to here, and that would be kind of the round number resistance up there. Now, if it gets over that, it could get as high as the 2035 area, which is basically this breakdown bar. And so, let's assume best case this week and just say this thing continues working higher. Well, I think that's about as far as you can expect it to go. That would take the NASDAQ to the top of its bearish retest region, NDX as well, and would take this to the bottom, and you have to expect this thing would fail in that area. If we look at the more likely scenario, it's the one I just outlined, and that is instead of moving higher from here, that we actually get some sort of a retrace and then the attempt to take it back up into that area. So that's kind of the two scenarios that I see. Either one potentially gets you up here. I think that's the higher probability. Still, it's just a question of how you get there. And, I guess if you're bullish, you probably would like to see a retrace here to have more strength to get up into the area. Just small one, right? Not much. Maybe come back into the top of this bar, 1965. That would give you, just do the numbers. 1867, 1965 is basically 100 points. So you'd take 100 on top of this. That would take you up to about 2065, which would take you deep into the retest regen zone. So, to quickly, do the numbers, show it this way. If we did a small retrace, right, that would take you all the way up into this area. That's the small one. If you did a larger one, of course, it doesn't take you as high. It just gets you to the lows of that. And then, of course, if you go straight up here, right, the odds of continuing are almost nil. That's almost a great short if, in fact, it did it that way. Finally, moving to the portfolio. There's not a lot to really show charts on here. We don't have much involved. The big thing last week is we took profits on the short side. And we added longs into Monday's plunge. And then we've been actually taking some profits on SBUCs on the way back up. We expect to do that with the IWM. I don't think it's worth trying to play the retrace, the first retrace, but to see what that bounce off that retrace is. And again, I'm saying the same thing that I just talked about. And that is that, we're up here now. I don't want to try to play a short on that retrace, whatever that is. What I want to play a short on is a failure to get back over this and stay over it, or a push back up to that retest regen zone. That's the better short up in that area. So that's the way it stacks up this week. Most of the sectors still negative. You've got a few that are strong. Outside of that, there's just not much. Okay, I hope that gives you a good sense of where we're at, probably where we're going. And until next time, I'm here for you. Just let me know if I can help. Otherwise, I'll just keep churning out as best I can indications of what is and isn't taking place on a daily basis so that we can stay on top of this volatile market. Have yourself a great one. Thanks. Bye.